Welcome to the presentation on Budget 2015. And the way these amendments have been done, I would say what an amendment, Sergi. Now, while we have detailed slides on each of these topics which are enlisted in this particular slide, for those of you who are short of time and just want to know what has happened at a high level, here's the summary. The corporate tax rates are proposed to be reduced to 25% from the existing rates of 30% over the next 4 years. While in the current year, there is no such reduction from 30%, how this is going to happen is something which we'll have to watch out. As against this, what we have noticed is that the surcharge has been increased by 2%. Okay, from 5% it has become 7 and from 10 it has become 12, effectively resulting in an increase in the tax rate of the company and an increase in the rate of dividend distribution tax, which is also liable to surcharge. There is a clarity which has been provided on the indirect transfer of shares. Things like, when would a indirect transfer of shares be treated as liable to tax in India? In what condition would a direct transfer or an indirect transfer of a company's share who is in turn owning shares in an Indian company work, and things like that has been clarified. There is an increase in the limit of the medical expenses which are eligible for deduction. If there is a merger of two schemes of mutual fund which are similar in nature, then on such a merger there is an exemption which has been provided to the unit holders. There are stringent implications for black money holders overseas. Now this is important. For people who have been stashing away their money overseas, there are very strict regulations which are proposed to be inserted, and these involve prosecution, penalties up to 300% and things like that. So people who have these things are definitely going to have a hard time on a way forward basis. The good news is the wealth tax has been abolished. GST is proposed to be implemented by 1/4/2016, and the much controversial GAR regulations, they have been deferred by 2 years. And what more? These regulations basically are proposed to be applied to transactions which happen post 1st of April 2017, which means all the investments which have been done up to a date which is prior to this date are grandfathered. There is no MAT on FII or the share of income from AOP, of course with conditions applicable in circumstances which have been discussed in detail. The additional depreciation which is provided under certain circumstances used to get reduced to half where the assets were used for less than 180 days. The law has been amended to provide that such additional depreciation shall now be available in the succeeding year. There is a penalty which will be applicable for concealment of income even if the company does not pay taxes under the normal route. There's a withholding tax which is proposed to be applied on EPF payment. There are deductions which are inserted for payments to certain specified funds. The withholding tax which was applicable to royalty and FTS payment, the FTS word is missing over here, but these two has been reduced to 10% from 25%. A welcome move. There is a deduction which is proposed to be provided for employing new workmen, and instead of the existing number of 100, if you employ more than 50 workmen, then you're eligible for this deduction. The mere presence of a fund manager in India will not result in a PE for the offshore funds. Again, a welcome move. The cost of compliance proposed to be reduced by increasing the threshold limit for applicability of domestic transfer pricing to 20 crores instead of 5 crores as it exists today. There are certain incentives which the government wants to provide for Andhra Pradesh and Telangana state by way of additional depreciation to certain undertakings which are set up in some backward areas. A much awaited clarification in terms of what will be the cost of acquisition of an asset which a company gets in a demerger has been provided. Effectively, it is going to be the cost of the asset in the hands of the transferor company. And again, place of effective management for foreign company. This is one more regulation which says that if the place of effective management for foreign companies or overseas subsidiaries of Indian companies are established overseas, but the place of effective management is virtually in India. Okay, then that is something which may result in this company being a resident of India. And the government is also going to propose foreign tax credit rules to provide for credit of taxes paid by an Indian company on its overseas income, which is also liable to tax in India. So these were some of the key changes, key amendments which have been proposed in the budget 2015. We are going to look at it in detail in the subsequent videos.